first for your listeners, let's take a step back. What the heck is the yield curve? Let's just define that to say, what is it? It's definitely, so there's policy rates, which is what any central bank sets, so in the United States, the Fed sets the policy rates. And then there's rate expectations, meaning when the rates market thinks the Fed would be hiking, for instance, in the US, they're not really pricing in any hikes, anytime soon. And then the yield curve is just largely a measure of inflation expectations in the future, because that's a risk premium. So like today, if you go out to a bank and you open up a CD, policy rates are close to zero. Maybe you get 5 basis points. If you say, how about I lock up my money for 2 years, you would get 10 basis points. And then if you say, hey, how about a decade? How about I lock up my money for 10 years? You would get paid a little over 1% to lock up your capital for 10 years. And that's because the yield curve is unnaturally low. And that's because a lot of people have been thinking, oh, they're going to do yield curve control and things are not going to be normalized. And so that's really the difference between short dated and long dated rates. And it's currently a little over 1%, which is a very abnormal situation. I think the best example I like to talk about is 2013 policy rates in the US were still near that zero bound, but it was just normal that if you went to a bank and you locked up your money for 10 years, right, 10-year lockup, that you would get paid 2% plus a little bit. There was no fear of inflation, no average inflation targeting, no blue wave in the United States, no fiscal spending, no Yellen in the Treasury. That was just normal. Today is not normal. And that's the kind of exciting thing for us with the IVOL ETF is we don't really need there to be some tail event or inflation. We just need a normalization in the rates market, which you've really already seen in the credit and equity markets, right? They've already priced in a recovery, but still a lot of investors in rates don't believe it, right? They're all hanging out. And you can see that with the level of 10-year interest rates, whether it's 10-year treasuries or 10-year swaps. Why in the world would you get paid 1%, when CPI is already higher than that? You're basically locking in a negative yield. So I think the yield curve is really largely, that risk premia is largely a result of investors' expectations for inflation in the future.